NIO stock has been absolutely crushed over the past month, falling close to 30%. Year to date, it's down almost 20%. For many investors, especially those who believed NIO could be the Tesla of China, it's been a painful ride. Today, we're breaking down why NIO is crashing, what's happening behind the scenes, and whether this presents a high-risk buying opportunity or a value trap. First, let's talk about the external pressures. NIO is operating in one of the most competitive environments on Earth, the Chinese electric vehicle market. Over the past year, Tesla, BYD, XPeng, and dozens of other companies have slashed prices aggressively to win over customers. Tesla alone cut prices multiple times across China in the last 12 months, forcing competitors like NIO to either follow suit or risk losing significant market share. The problem for NIO is that its brand has always been about luxury and premium service. Unlike BYD, which targets the mass market, or XPeng, which focuses heavily on tech innovation, NIO has built its identity around a high-end customer experience, beautiful designs, in-car technology, premium lounges, and battery swap stations. When you start discounting your luxury product aggressively, you don't just hurt your profit margins, you also risk damaging your brand positioning in the eyes of customers. That's a dangerous long-term risk that many investors are starting to factor into their models. Now, let's look at the financials. Despite growing its deliveries by over 40% year-over-year, delivering more than 42,000 vehicles in Q1 2025, NIO's revenue for Q4 2024 still came in below expectations at $2.66 billion. Even worse, the company posted an earnings per share loss of 36 cents, missing analyst estimates by over 12%. These misses weren't small blips. They point to structural challenges around profitability. While delivery numbers are the headline everyone likes to focus on, what really matters is margin, the amount of profit NIO makes per vehicle sold. With heavy discounting and a rising cost base for materials and labor, NIO's margins remain thin. It's a volume growth story, but without clear profitability, and that's spooking both retail and institutional investors who have become much more risk-averse over the past year. There's also the broader macroeconomic environment. China's economy has been sluggish. Youth unemployment remains high, consumer confidence is weak, and property markets, traditionally a key source of Chinese wealth, are under significant pressure. These conditions make big-ticket purchases like electric vehicles harder to justify for many Chinese consumers. Additionally, rising global tensions, especially between China and the United States, are making investors even more cautious when it comes to holding Chinese equities. Regulatory risk, tariffs, and potential delisting fears all add layers of uncertainty to stocks like NIO. But it's not all bad news. NIO has been working aggressively on multiple fronts to strengthen its position. The new ET9 luxury sedan, featuring a 900-volt architecture, dual-motor all-wheel drive, and a CLTC range of over 650 kilometers, has finally launched. It's positioned to target the ultra-premium segment where Tesla's Model S and Mercedes-Benz's EQS are dominant. Early feedback on the ET9 has been positive, with many reviews praising its build quality, ride comfort, and technological advancements. At the same time, NIO is entering the affordable EV space with its Firefly brand, launching a compact model priced around $20,000. This move could open a massive new market for NIO, both in China and eventually in Europe. It's a bold strategy, attacking both the top and bottom of the market simultaneously, but it comes with huge execution risks. And then, of course, there's NIO's big bet on battery swapping. While most automakers have doubled down on fast charging networks, NIO is betting that customers want an even faster, more convenient solution. Its goal is to build over 4,000 battery swap stations by the end of 2025, with 1,000 of those outside of China. The strategy offers some unique advantages, especially for fleet operators and rideshare drivers, but it's also extremely capital-intensive. Each swap station costs hundreds of thousands of dollars to build and maintain. If battery swapping doesn't scale as hoped, NIO could find itself with massive sunk costs and a very narrow market. So, the big question, is NIO a buy at these levels? It really comes down to your risk tolerance and your time horizon. At today's beaten-down prices, NIO could offer a compelling risk-reward setup for long-term investors who believe in the company's vision and are willing to endure more volatility along the way. The EV market is still growing globally, and NIO remains a strong brand with innovative products and a loyal customer base in China. However, the risks are real. Without a clear path to consistent profitability, and with macroeconomic headwinds continuing to blow strong, NIO could struggle for longer than bulls expect. Dilution is also a concern. To fund its massive expansion plans, NIO may need to raise more capital, which could hurt existing shareholders. In short, NIO today is not a safe play. It's a classic high-risk, high-reward investment. If you believe in their execution, innovation, and China's EV future, you might see incredible upside over the next 5 to 10 years. But if you're looking for short-term gains or lower volatility, there are probably better opportunities elsewhere. As always, do your own research, manage your risk carefully, and remember, hope is not a strategy. Thanks for tuning in. If you found this breakdown helpful, don't forget to like, comment, and subscribe for more straight-shooting analysis on the EV sector and growth stocks. See you next time.